If you observe carefully how most Americans are saving money in 2026, you'll notice something that almost no one is discussing with the necessary seriousness. The way you're probably keeping your savings safe isn't just suboptimal. It's a mathematical guarantee that you'll become poorer each year, even if your bank balance grows. This isn't about market crashes or dramatic collapses. It's about a quiet, relentless erosion that's already happening to millions of savers who believe they're being responsible. Let me explain why. For over 40 years, I've studied patterns that repeat throughout financial history. Monetary crises, debt cycles, and the subtle ways wealth transfers from those who don't understand these forces to those who do. The question that needs to be answered isn't whether your savings account is FDIC insured. The question is, can the purchasing power of your savings survive what's already in motion? Today, I'm going to share something that should concern every American who cares about their financial future. This isn't a prediction. It's a logical consequence of forces that have been in motion for years. History is an excellent teacher, especially when it comes to understanding how savings and currency systems work. When you understand incentives, you understand behavior. And the incentives today are aligned in a way that makes traditional savings strategies increasingly dangerous. Consider these facts. The United States national debt reached $38 trillion in 2025. Up from $28 trillion just 4 years earlier. The Federal Reserve's balance sheet now exceeds $8 trillion. The M2 money supply has increased by over 40% since 2020. This doesn't mean economic collapse is about to happen tomorrow, but it means we're entering an era of monetary uncertainty we haven't seen in decades. Money has no intrinsic value. Its value comes entirely from confidence. Confidence that others will accept it, that governments will maintain discipline, that the supply remains relatively stable. When these pillars weaken, currency value begins to decline. This doesn't happen linearly or predictably. Imagine a dam. For years, water pressure builds gradually. Small cracks appear, but the structure seems solid. Then one day, those accumulated pressures reach a critical threshold, and the entire dam gives way all at once. This is how currency devaluation works. If you observe current economic data carefully, you'll see that pressure is building now. Real inflation has been running between 8 and 12% annually for typical American families. Meanwhile, savings accounts pay perhaps 4% interest, and after taxes, you're lucky to keep 3%. Your account balance grows in nominal dollars while your real wealth shrinks. You might be thinking, but savings accounts are safe. They're FDIC insured. Let me show you why this matters more than you imagine. History is an excellent teacher. In the 1970s, the United States faced a crisis that shares many similarities with today. By 1979, inflation reached 13.5%. Savings accounts paid perhaps 5 to 6%. Imagine a typical middle-class family who'd saved $50,000 by 1974. They kept this money in a savings account, believing this was the responsible choice. By 1984, that account had grown to perhaps $80,000 with compound interest. But here's the problem. $80,000 in 1984 bought less than what $40,000 bought in 1974. This family worked for 10 years, saved diligently, and became poorer. We saw similar patterns in Germany during the 1920s, though in more extreme form. By 1923, hyperinflation had become catastrophic. People who'd saved their whole lives in Reichsmark-denominated accounts discovered their life savings couldn't buy a single meal. The savers were completely wiped out. Those who shifted their wealth into real assets like land or precious metals survived and prospered. Consider Britain in 1967. The British pound had been the world's dominant reserve currency for over a century. Yet on November 18, 1967, they were forced to devalue by 14% overnight. British savers who kept everything in pound-denominated accounts lost 14% of their international purchasing power in a single day. The lesson is that confidence in monetary systems can erode, and when it does, traditional savings vehicles lose real value regardless of what your bank statement says. If you look carefully at these examples, you'll see a common thread. Every time governments face the choice between maintaining currency value through discipline or creating money to solve immediate problems, they choose money creation. This isn't about politics, it's about incentives. To truly understand what keeping money in traditional savings means in 2026, you need to comprehend three fundamental principles. The first is the law of monetary supply and demand. When supply increases faster than demand, value falls. Think of it this way. It's like adding water to milk. The volume increases, but the concentration decreases. The Federal Reserve and government are creating dollars at rates far exceeding economic growth. Your savings account balance stays the same or grows slightly, but the total supply of dollars is growing much faster. When the money supply grows by 15%, but your savings grow by 4%, you've lost 11% of your real wealth. If you have $500,000 in savings vehicles paying 4% while money supply grows 15%, you're losing the equivalent of $55,000 in purchasing power annually. The second principle is the Cantillon effect. New money doesn't enter the economy evenly. Those who receive it first benefit most. Those who receive it last suffer most because they face higher prices without offsetting income increases. Asset owners, those with debt, those close to money creation, they all benefit before savers do. By the time your savings account interest rate rises slightly, asset prices and living costs have already surged. Housing prices have risen 70% since 2020 in many markets. Yet savings account rates barely moved until recently. The third principle is the real return illusion. Most people focus on nominal returns rather than real returns adjusted for inflation and taxes. We are currently in a late stage of the debt cycle where money creation has accelerated dramatically and inflation pressures are building despite official assurances. Right now, all three principles are converging. This is the machine that's transferring wealth from traditional savers to those who understand these dynamics. Let me tell you the story of two families during the 1970s inflation period. The Martinez family and the Chen family were neighbors in suburban Denver in 1973. Both had saved $40,000. The Martinez family kept their savings in a bank account paying 5.5% interest and treasury bonds paying 6%. It seemed prudent and safe. The Chen family made different choices. They kept $10,000 in savings for emergencies, but moved $30,000 into gold and silver bullion, dividend-paying stocks, and real estate. It seemed riskier. Fast forward to 1983. The Martinez family's $40,000 had grown to $75,000, but cumulative inflation during those 10 years exceeded 130%. Their $75,000 in 1983 bought approximately what $32,000 bought in 1973. They'd lost 20% of their real purchasing power. The Chen family's portfolio grew to approximately $109,000, representing about $47,000 in 1973 purchasing power, an actual real gain, while the Martinez family lost wealth. This isn't a made-up story. It's the typical pattern. The difference wasn't intelligence or luck. It was understanding that when monetary system rules change, the strategies that once seemed safest become the riskiest. Now, let's translate this to what really matters, how this affects you. If you're between 40 and 80 years old with $300,000 or more in savings, primarily held in bank accounts, CDs, and bonds, you're taking a concentrated risk. They're all denominated in the same currency being created at unprecedented rates. Consider a plausible scenario. Current policies continue between 2026 and 2030. The logical consequence is continued money creation at rates exceeding economic growth, a steady 10 to 15% annual erosion of purchasing power. Almost everything you buy is affected. Your gasoline reflects global oil prices. Your groceries, medications, healthcare, utilities all increase when the dollar weakens. Even if your bank balance stays the same, your real purchasing power diminishes significantly. And if you're approaching retirement, you don't have time to recover from major purchasing power losses. If you have $500,000 saved and real inflation averages 10% while your savings grow at 4%, in just 7 years, your purchasing power will be approximately $315,000 in current dollars. You've lost 37% of your standard of living because monetary decisions you had no control over eroded the currency value. Consider a 62-year-old couple with $700,000 in retirement savings, $350,000 in savings paying 4.5%, $250,000 in CDs and bonds paying 5%, and $100,000 in stocks. In a scenario where real inflation averages 11% while their savings yield 5%, the mathematics become painful. Over 5 years, their real purchasing power could drop from $1.35 million to under $900,000, a loss of more than 33% during their early retirement years. This isn't alarmist speculation. It's mathematics based on what happened during the 1970s. This is the cruelest impact. People who worked their entire lives and saved diligently can see their plans destroyed by systemic forces beyond their control. This is why understanding these cycles is crucial, to take protective action while there's still time. Based on historical patterns during monetary stress periods, here are practical guidelines. This isn't specific financial advice. These are educational principles you can apply with professional guidance. True diversification means owning assets that respond differently to the same economic forces. A prudent protection structure should include 30 to 40% in productive assets with pricing power, dividend-paying stocks of essential companies, REITs with inflation-indexed leases, 15 to 20% in tangible assets, precious metals like gold and silver, commodities or commodity producers, 15 to 20% in international diversification, foreign currencies of fiscally disciplined countries, international stocks in growing markets, 10 to 15% in cash and liquid reserves, savings for emergencies, treasury bills for liquidity, 10 to 15% in alternative protections, cryptocurrency for those comfortable with volatility, sector-specific investments you understand. Notice only 10 to 15% stays in traditional cash savings. Enough for emergencies, but not so much that inflation destroys your wealth. Each category responds differently to monetary stress. When currency weakens, tangible assets and international holdings gain. When inflation accelerates, real assets protect. This portfolio works across multiple scenarios instead of betting on one outcome. The best protections have certain characteristics. They're difficult to create more of quickly, maintaining scarcity. They have demonstrated demand across different economic systems. They generate real cash flow you can use regardless of currency fluctuations. They're portable and liquid enough to convert if needed. Avoid long-term bonds locking in low rates when inflation is accelerating. Avoid companies with high debt and low pricing power. Avoid assets denominated only in dollars with no inflation protection. Maintaining sufficient liquidity is crucial. Keep 12 to 18 months of expenses in liquid assets. This serves critical purposes. When opportunities appear, you'll have capital to deploy. When unexpected expenses arise, you won't be forced to sell investments at unfavorable times. Implement protective changes gradually over 6 to 12 months. Transfer about 8 to 10% of your assets per month from traditional savings into protective categories. This reduces timing risk and allows adjustments based on new information. If you decide to shift to protective assets, be prepared for volatility. Precious metals can rise 15% one month and fall 12% the next. Remember, you're not buying these to get rich quickly. You're buying them as protection against systemic monetary risks. Maintaining this perspective helps you stay calm during inevitable volatility. Common traps people fall into: analysis paralysis, over-concentration in one asset, waiting for perfect timing, and ignoring taxes and costs. Doing something imperfect is better than doing nothing. The goal is to preserve purchasing power with controlled risk across scenarios. Time in protective assets beats timing the market. Every choice has a cost. Shifting to protective assets has costs, transaction fees, potential volatility, complexity. But keeping everything in traditional savings also has costs. Guaranteed purchasing power erosion, concentration risk, potential for dramatic losses. The question is, which cost you prefer to pay? For most people approaching retirement without ability to earn replacement income, the cost of inaction through purchasing power erosion is much greater than the cost of taking protective action. History teaches that periods of great monetary creation are always followed by wealth redistribution. The wealth doesn't disappear. It transfers from those who hold depreciating paper currency to those who hold appreciating real assets. Those who position correctly before changes become obvious benefit enormously. Those who wait for certainty discover too late that the world has changed. The choice is yours. But remember, in history, ignorance has never been a defense against the consequences of systemic changes. Central banks worldwide are buying gold at record rates for a reason. Major institutions are diversifying away from pure dollar holdings for a reason. All these reasons point in the same direction. We're entering a period of fundamental monetary changes. How you save your money may be one of the most important financial decisions you make in the coming years. The question isn't whether you should pay attention to these signals. The question is whether you'll act based on what they're telling you. The time to prepare is before everyone realizes what's happening, not after. And that's why this channel exists. We observe the signals before they become obvious to everyone. We study cycles, not trends. We focus on principles, not predictions. If this analysis makes sense to you, subscribe to this channel. History is being written now. Make sure you're on the right side of it. The prepared don't panic. They position themselves appropriately for the world as it is. Nothing in this constitutes specific investment advice for your situation. Each person has different circumstances, risk tolerances, and time horizons. Consult qualified financial professionals who understand your complete picture before making important decisions about your wealth. What matters is understanding the principles at work and being prepared for different scenarios.